Okay, so we're gonna cover two topics today. One is, the actual succession planning, and it's really about options and what options are available to you and your company and your specific situation, but also the goals for where you'd like to see your company go. And it's a it's a big continuum there of possibilities.
So we're going to start off by really just telling you who, obviously you know us, but first is the introduction for us, then we'll get into the meat and bones of the thing.
Yeah, Mike already, he introduced us. We're both former chairs. Bill and I have a similar background. For me, it was working for a publicly traded company. Bill was privately held in a family business. But we had a very similar backgrounds. I mean, I used to be a CPA many, many years ago.
Arthur Anderson.
Yep, Arthur Anderson. And, but, once I left public accounting and went into industry, I never really liked accounting very much. And the thing I didn't like about it was, for me, it was always looking backward. And I found I got a lot more satisfaction out of trying to develop a plan with a team and execute that plan. And so I got a lot of satisfaction out of doing that. But my accounting background was a really, really good technical foundation to allow me to understand business.
I also started in accounting, also at Arthur Anderson, but I realized very quickly I wasn't a very good accountant. But I'm much better at managing an accounting firm than I was at being a bean counter. So what ended up happening is I started my own CPA firm, eventually sold it to American Express, and then bought into the family business. And now we've sold that business. Yeah. So here we are. So this is first, again, part of telling who we are. Our company that we ended up starting called Beanstalk Community, or Collaborative Community Wealth. Basically, it's a mouthful, and I really dislike the name, but I like the Beanstalk part, but it's who we are. And it really does describe us. Our whole goal is to buy companies, buy, build, and hold them. The commercial will end real quick, I promise. But what we've been doing is trying to get companies that are in a community and to keep them in the community and to never sell these things. So to buy, build them up, and hold them. Because every company has some warts. Every company has some issues. So we're also trying to guide just owners that want to leave. So the whole process is to try to help them. A win-win situation is how Troy describes it. So, so we're investing to support the long term of that community and that company. We give growth opportunity. Our whole thing is the employees. We want to give them part of the action. If they're part of the whole thing, so we've got a whole business plan to allow employees to be part of that as well. So, and if we do all that stuff, then the company stays, community gets more valuable. Everything is good. So, and it was really cool to hear that the United States is still the second largest manufacturer in the world. That was a fun thing to hear yesterday.
Yeah, if you look at the U.S. And if you took U.S. manufacturing and put it, the GDP that it generates compared to the world economies, manufacturing in the U.S. would be the 8th largest economy in the world. So even though we feel like it's been under pressure and it's reduced, it's still very significant. And we believe that keeping these businesses in their community is vital, and that's for our future and our country's future, and that's why we created what we did. Yeah. Okay, so today's agenda, succession options for privately held business. We're going to talk about that a little bit because there's a lot of factors there that really dictate what options you do have available. And Bill's a very good story of this. And if you go to our website, there's a video there where I moderate a discussion with Carla Aaron. Many of you know Carla. She had a small business not far from here in Hialeah, Florida. And I'd say she was at one end of the spectrum of availability, of what she could do with her business. And then Bill would be more on the other end of the spectrum, and he'll explain what options that he had to look at when he made his decision on how he and his brother made a decision on how they wanted to exit the business. And then we'll spend a little bit of time just talking about how we, and we're a good indicator of how a firm that would be looking at your business, if you decide you wanted to sell the business or if you value the business, how we would look at it to put a value on it. And then we talk about company uniques. These are very specific things that we look at, and they're really a measure of risk. And as risk increases in a transaction, the valuation goes down. As risk goes down, the valuation goes up. So these are the things, the factors. And again, we don't think we're unique in this, in the evaluation, but so it's important for you to consider these things as you look at your own business. And then some strategy and tactics to assess, and create value. And that story may look very different depending on what your chosen succession option is. You may have a different focus depending on which way you'd like to succeed your business. Any questions before I move on? Okay. So on the succession options, we put them into generally three, and the third one is not a good option, by the way. Unfortunately, we see the third option sometimes is the only option available for companies.
In case you can't read that far, it says orderly liquidation. You're just selling off your assets.
Yeah. And generally a going concern is worth a lot more than the underlying assets of what you're selling. But we do run across businesses where I think the business has reached its peak maybe some years ago, and the owner's hanging on, and they're hanging on, and they're hanging on, and they're hanging on, and they're hanging on, and now they're past the point, and they're old, they're tired, and they don't have a good way to succeed the business. And unfortunately, and that's the worst option we tell people, because then everybody suffers. The seller didn't get the value, the employees don't have a job, and the community loses that contributor. And manufacturing is a significant contributor in a community as compared to an accounting firm or a law firm. It really generates a big multiplier effect in a community. So we're not going to spend a lot of time on that one because we don't want that one to be a real option. But the first two are really apply to, I think, everyone in this room. And how many here work in businesses where they have family that are family members that are working in the business? You can see a show of hands.
Okay, how many do not have that? Okay.
Yeah.
It's probably more significant.
Yeah. So family succession, and really I think, management succession, there's a lot of comparables there that on how you want to look at the business and set up the business. It's very much the same for the seller and the buyer, and we'll talk about that. Or there's also the option of an ESOP too, where you transfer it to all the employees versus just the management. And Bill, tell us a little bit about the external side, because you were, explain where Termax was and what you went through when you did yours. I think this is a very valuable story that people can relate to.
Well, this was my father's business. After I sold my accounting firm, I went to work for him for a week. And after a month, I bought him out because he's a very difficult guy excuse me, Dad, in case you're watching. It didn't work as easily as I thought it might. So what my brother and I then approached him, figured out a way to buy him out. And then worked out great from that standpoint. But we grew the company from about $2 million in sales, $2 to $3 million, to $95 million over the next, at that point, about 17 years. And our whole thought, it's not that we're that, I mean, it was big, but we had a lot of options to sell it. Like many of you, I'm sure you get those weekly or monthly people sending you something saying they want to buy you out and all that. So I thought about it, and back from my accounting days, that's what I had done a lot of, was helping business owners realize what to do and where to go. So some of the people that looked to buy us were hedge funds and equity people. They thought they had a good deal. And hedge funds and equity guys, they only want over a certain limit, like $50 million. It's probably a little bit different than that now, but that's what it was 4 or 5 years ago. So they want something that's profitable. They want to have it so that it is at certain levels, because whether it's a small or a big company, the same amount of work is necessary. I mean, you still have to do just as many things. So they would rather have a bigger investment, and their goal is to double their money in 5 years. So that's a 20% return. I mean, annual return. Well, if you think about your net profit, you got to get 20% return every year to be able to give them what they need. Does that make sense? So our whole approach was a private equity buyer. They have different needs. So I looked at it and thought, well, and plus, they're looking to try to what do you call it, turn and burn? I mean, they bump and up, right? There's just a lot of ways that they approach it. My kids, though I have 7 children, the ones that could run the company were not involved in it. And I thought the best thing for my family was to go ahead and to actually help my kids, was not to put the burden of the company on them, but was instead to go ahead and find a way that they could, I could help them out. They would have, or the ones that wanted to do it, would have probably run it into the ground. As much as I love my kids, I love them too much to do that to them. So, what ended up happening, I knew that what was left for me was a strategic buyer. So I found a strategic buyer means somebody that wants to go ahead and increase, either go into a like market. We were automotive fastener maker, so something like that, or to find somebody that was going to be a competitor. Now, competitors are a little more difficult because, well, you're telling them what you're doing, and so it just took a lot of work. Well, I found a company that did the same thing we did, except they were in France, and worked out pretty well. Well, it did work out well. I mean, it's a good marriage. They kept all of our people. We're still, or Termax is still the shining star for their production group, and it, so is that?
Yeah. I mean, at $95 million, Bill had every option available, to him, because we'll talk about, how PE works, where that size, he could have been at what's called a platform company. Somebody wanted to come into the space, and then you start doing add-ons and rolling that up, and that's how they work. The case of the strategic buyer that was not in this market, I think you accomplished a couple goals. You were able to make sure the business continued and his employees had the opportunity to continue.
Right.
And yet not going through the risk of exposing his company to competitors like real friendly people like ITW and Stanley and stuff like that are wonderful automotive people that many of you all know how these guys are. So he had a lot of options. You look at the other end of the spectrum where Carla was, she actually had to create her own buyer. She had to develop an employee and help through that whole process and go through a earn-out process to be able to get that company sold. It was a company, I think she had 9 9 or 11 or 12 employees or something like that. And, but, you know, she had to work really hard to get that sold.
And the owner then does most of the work in selling that, because generally, when, and in her case, what happened was that she did have an employee that she identified that could do it. It was, you all have a gut feel whether people can make this thing work or not. And she found that guy, but he had no money. So she had to go ahead and help him with resources. She had to help him. And I just read recently that in the US, I think it's 71% are owner-financed sales. So it's just how the process works. So that you're still kind of involved. You want to see them succeed.
Or you have to be involved because you're
Get
financing
paid.
it. And you have to make sure the transition works. The worst thing is you pass the company off, you exit, the company doesn't do well, then you have to come back older and with the company in a worse situation than what you left it. So, which is not a good thing. But with, you know, there is so much money out there right now in private equity, and so that you know, Bill was talking about the transaction size, that number's been coming down because they have to deploy that capital. You know, they raise a fund, they got to go out and buy stuff, and then they got to get that capital employed and started. So the price points have been coming down, but you know, we're still seeing if your company's sales are say 10 million or less, you're not going to get a lot of private equity play there. You know, it's just too costly. The due diligence costs too much. As Bill said, you still have to do a lot of work, and the transaction size is too small. Well, let's talk about family succession. You know, we up here in the green area, you know, it says, for those who can't maybe see from the back, it says if the succession strategy is to succeed the business to a family member or the management team or employees, the following should be considered when it determine the option's viability. You know, first thing is, you know, the successor must be capable and prepared to manage and grow the business. So, you know, if you're, you know, be it a family member or your management team, you know, you really got to get them involved in the process and, you know, identify who that successor is, and you got to develop them, you know, because they're going to be the future business owner. They have to have the right risk profile that they'll be able to take that business on and that they want to do that. And they have to be capable, because if it doesn't work and if the business is such that, you know, you're doing seller financing of the business, then it's extremely important. You know, a lot of privately held businesses we look at, the ownership keeps everything very close to the vest, you know, and they don't share a lot of data with employees.
By the way, we'll give you these slides, so, I mean, it's fine, but I know it's hard to see from the back of the room, so.
Yeah.
I recognize that. Yeah.
So you know, they hold that information very close. They don't develop it. We just bought a business in Minnesota where the general manager and the engineering manager, they'd never seen a financial statement before. They didn't understand the whole concept of what gross profit was, and yet they're doing all the quoting, and they didn't have the systems and stuff to really even understand what their costs were. And so, you know, when I came in and I started looking, they do really well as a company, but my goodness, the variability of profitability on contracts, and that the sellers didn't understand it either,
Right.
Frankly. They didn't understand it either. So there's a lot of opportunity where we can help them. But, you know, these people could have never succeeded that business to these two gentlemen because they did not prepare them to be able to take that business. So if that's an option you think you want, then this is a long time in developing that management team. So don't underestimate that, because if you don't do that well, frankly, it may not be an option, you know, that's really viable.
I want to back up one. I know many of you are at different levels of this whole journey here. Some are thinking about doing stuff now. Some are wondering all the details of it. Just so you know, we're trying to go ahead and give how the process works and trying to make it as easy as possible for everybody. So I apologize if we talk down to you or up to you or whatever. And if you don't know some, feel free just to ask. It's fine.
Yeah, I have to just interrupt and ask any questions if you have some. So from the seller's perspective, though, if this is an option, we got some boxes here you need to be able to check off. You know, that if your seller, if the deal requires you to seller finance this and that applies to, you know, kids, management buyout, or an ESOP, you know, all that could require this because the money has to come from somewhere. And if a bank's not going to back it or something, then everybody's been coming to you with their hand out. So, you know, you've got to decide: am I going to accept a delayed payout where I get paid over time? May have to continue to personally guarantee the debts because the buyer, if it's a management team or whatever, they don't have the financial wherewithal and credit to do that. So, are you willing to do that? Finance the transaction with a seller note, you know. So you may be a debt holder on the business, but I assure you if a bank's involved, you will be at the bottom of the pecking order with the bank. The bank will get their stuff first. You'll be above any equity, but you know you're still at the end of the line. And then, you know, if the successor doesn't do a good job and you have to take back control of the business, you have that risk, and nobody really wants to do that after they've left the business. So that's from the seller's perspective. From the successor's perspective, you know, that person's going to take it. Do they have that risk appetite? You know, are they going to put their house on the line? Where, you know, the banks they say, well, show me all your assets. Yes, that's what we want collateral on. Whatever you have, we want you to tell us, and we want that. That's what they do. That's what the bankers do. And then on the ESOP, if it's a sizable enough company, that could be a good option, but you really need to dig into that because there's a cost for doing that, and there's a control issue. You got a lot of potential owners of the company. I know it was interesting. Company, is anybody familiar with it's a big brewery out in Colorado, New Belgium Brewery? Well, it was the owners of that. They created it, and I think they opened up another brewery in the North Carolina or somewhere like that. But they made it an ESOP because they really wanted to transfer it to the employees. Well, the employees took it and they did it, and then they sold it and they made a ton of money. So that was sort of a twist on things, but anyway, there's that could be a good option for a sizable company that you can look at. You just have to understand the cost to put it and to administer it. So, but any questions on succession planning? Because this could apply to a lot of people in here. Any questions you may have regarding that option or these options?
Good.
All right. I guess we did a good job of explaining it then.
Or they're bored.
All right. So, we're talking about different buyers, say in a private equity setting. You know, as we said, you know, Bill said, you know, I mean these funds, private equity goes out and raises large funds now, $50, $100, $200 billion, and they want to roll up a space. A strategic buyer, you know, they may be in the business, and they're also trying to roll up things to get efficiency. So they have a similarity on how they operate. Their whole deal is, if I put things together, think about it this way: if you had 10 companies that were doing $10 million each, and you added them, they may be valued at 4 or 5 times EBITDA, right? If you roll them up to where it's a $100 million company and you just kept everything the same, you'll get a multiple pickup just by the fact that the size is bigger, all right? Meaning instead of trading at 4 or 5 times, it may trade at 7 or 8 times or something like that. So just by putting those together, you can create value that way. But then they take it further because, you know, these 10 companies, they had 10 accounting departments and 10 sales departments and 10 whatever, and that SG&A cost, that selling general administrative cost. Every dollar that they reduce there, if you're trading now at 7 or 8 times, every dollar cost reduction, they're increasing the value by $7 or $8. And this is how they make money. You know, so they'll go out and they'll buy a bunch of companies. They know they're going to close some of them down. You know, they're just putting these things together, and then they're going to build this thing, and in, you know, 5 to 7 years they're going to flip it, and get a big return. They get, you know, 2% fees every year, and they get 20% of the equity pickup. And then they give a great return to their investors so they can go raise another fund and do this all over again. And that's where, you know, private equity is 50 years old, and this is what it's evolved into.
Yeah, and it's really a failed model. But the problem is those are the guys that are going to be talking to. So I'm warning you ahead of time. Try to avoid that if you can.
Well, that's our opinion. This may be what
true.
This may be what you want, but you know, this is one of the big reasons why we started Beanstalk, because we wanted companies to have other options, especially smaller companies. So, but that's how they create valuation, is, you know, by eliminating duplicate costs. You know, they can also, you know, they can expand the market. You know, they can have a bigger footprint in the market and control both from the sales side and on the purchasing side. Yes, sir.
Can you, Bill, explain that when you say that the failed
Model?
Failed model.
Yeah.
It's successful, but I understand.
Well, it's not necessarily successful for the company, right, or the employees. And I don't know the exact amount, but it's a lot more fail than succeed in that model. It's difficult. That's all I'm trying to say. So I've seen it both as an accountant. I've helped people do it that way. I looked at it for ourselves, and we kind of modeled out what would happen to our company if we did that, and it's kind of scary. I mean, but a lot of times they are the best. I mean, it's going to get you the most money, so sometimes that's worthwhile. But there's so many different stakeholders involved in this stuff: employees and banks and community relationships, and you know, I just don't like it.
Our opinion is it's a failed model, because long term, if this continues, you know, it's like the whole issue with the middle class. It's becoming smaller, right? And if there's just not the opportunities there, everything that's done there is with the intent of making a certain return in a short period of time. And these are long-term businesses. So that's why we say it's a failed model.
We probably should have not. I shouldn't have been so adamant, because I know some of you guys are owned by private equity and all that. So I apologize.
And not everyone's like that. You know, not every single one is that way either. It is a lot of that. You know, and it's you know, Ted, our partner, he was, you know, he was in private equity for a long time, but it was when they would actually be like, they're more like turnaround guys. And it was very different than what it is today, which is we've got $100 million to employ. We buy things very quick, slash, burn, cut, do, and make this happen. And then get a certain threshold return, and then do it again. You know, and then we optimize everything in this country. I always say, when I lived in Europe a couple times, what would I reduce? How do you describe the U.S.? I say, We're fantastic at taking a good idea and optimizing it to making it a bad idea. We take everything to an extreme, and that's sort of what we've done here. You know, Ted was telling us the other day that to enhance the returns on private equity, and because money's so cheap, they'll raise a $100 million fund, but they'll actually go borrow money. Instead of using the $100 million they've raised and calling the money in, they'll get a really cheap, effectively like a line of credit to go buy everything, and they wait to the last second to deploy that capital so they can enhance their return. Because they got cheap money, they pay the cost, and then they can enhance their return to make their story better. You know, and it's just all this optimization of this stuff, and it's just like, it's maddening. Anyway.
Off subject, sorry.
Yeah, sorry. So off our soapbox on that. So those are the benefits. Of course, this doesn't always work. You know, this whole roll-up strategy, not every private equity idea works. You know, sometimes they really, because they're moving so fast and their horizon is so short, they cut too deep and they cut muscle and not fat, and now they have trouble running the business, and the business does not do well, and they don't get the returns. You know, so they shut those parts down, and they have to reposition. Whoops.
They have poopy in their pants.
Yeah, yeah. You know, if they sell to a competitor, and if it's a pretty tight space, a lot of times the customers don't like that. You know, and maybe the customer may feel like they have too much exposure with one supplier, and they end up losing some business then. So we've seen that happen. Whoops, I keep hitting the wrong button. And then you know, this idea of merging all this stuff, it looks good on paper, but it doesn't always work in reality as they penciled it out. So they, you know, not every one of those things are a success. Now this is truly when we're talking about private equity, and I think this is where I would perceive where when I said Bill, you know, Termax had a lot of options. They really could have been, you know, a platform, which effectively that's what they ended up being for Lisi.
Yeah.
Because, you know, they were of a sufficient size. Or they could have gone and been part of a roll-up strategy of an ITW or somebody like that, and just been a plant. You know, it's not like a separate running business, but we're just more capacity adding on to the ITW portfolio, right?
I should tell you one real brief story about when my dad had the company. He actually had sold it to ITW, and had everything worked out. I think he was about $3 million sales at that point, and he was selling it to him for $3 million himself. So one-time sales. He thought he had a good deal with this whole thing, but at that point he'd already kind of semi-retired, and all he did was he had a general manager that would not sign a non-compete clause. So what ended up happening was that manager ended up having my dad over the barrel, and ITW walked away, and the general manager got fired, and we came in, and he asked us. I had just sold the accounting firm, so that's how we can. So the point is, there's lots of roadblocks that happens along the way. But ITW they were very acquisitive. Isn't that a good word?
Bill was your brother there? Ben?
No.
No, so was
Yeah. I brought him in. Okay.
So we gotta
we in time?
hoof it up here.
Okay, sorry.
So no, it's all right. I just sort of lost time here. Just these are things I'm sure you all know, but just again, as Bill said, we're not trying to talk down anybody, but we want to make sure that it's understood. So you know, EBITDA. I'm sure everybody's heard of this word: earnings before interest, taxes, depreciation, amortization. It's a simple measure of the company's performance. It is usually the item that you apply a multiple to when you say there's a valuation of a business. So if you have a $2 million business and you say it should be valued at 5 times EBITDA, it's a $10 million enterprise value. And an enterprise value is the measure of value for the entire company independent of its capital structure. And what that means is it doesn't matter if it's equity finance or debt finance, it's just what is the value of that company. What does the capital structure, where it does affect what's important to you as a seller, for example, is the equity value. So this $10 million business, if one business has $3 million of debt and the other one has 5, then the equity value of company 1 is $7 million, so the 10 less the 3, or the equity value of company 2 is $5 million. Because deals are done, it's generally no cash, no debt deals. Excess cash goes to the seller, but the seller has to take care of any debt that they have on the books. So
That's an important concept. I hope you understand that. 'Cause
Yeah.
that's how you're going to value these things.
Any questions on the math here? Understanding?
Working capital, all that.
Pardon me?
Like you mentioned cash, but are you including, APAR?
No, that's all part of the business. It's just the excess cash. Because all that other stuff is, because you're buying a going concern, even if it's an asset purchase, you have to have the sufficient working capital to run the business. So, factors that drive the number of interested parties that you have. So this is where we say, you've got the EBITDA, annual sales, we say size matters. So the bigger that is, the more opportunities you have. Again, the Carlos story versus the Bill Termack story. The industry that you're operating in. Also, are you in a dying industry? Are you in a tech where everything is, the future is bright and the growth in that industry is expected to be large? Fragmentation in the space. If it's highly fragmented and a private equity play comes in and says we want to roll that space up, and you've got a platform opportunity where your company could be the platform, you may be able to get a lot of value for your company if you're in that position. For some investors, location is really important. They may have a bunch of businesses and they want to be near that business where they can manage that group of businesses. And we're going to give you some examples. This is just stuff that I pulled from the internet and I sanitized some of it. Has everybody heard of the term family office before? Have you heard this term? Well, for those who haven't, it's generally an existing business and they've done well. They've got capital they want to employ. They've got expertise, so they look for businesses to buy and manage and run. And this is just, again, some criteria for this specific family office. 3 to 3 million in EBITDA. Again, location was important to them. Operations within North American, primarily in the Midwest. And then the activities, they were interested in manufacturing, distribution, and asset-intensive services. And this is just right from their website, what they're looking for. This is sort of our criteria, $500,000 in EBITDA, 3 to 20 million in revenue, and these industries and, certs and stuff like that are important to us.
The point is that different buyers are going to have specific criteria that they're looking at. And so you want to make sure you don't waste your time with somebody that's really not going to fit for them or for you.
For you. Here was a small private equity where it's very clear. They've got, if you're a platform opportunity, we want you to look like this. If you're part of the add-on, this is what you can look like. It's a very different thing. So it's pretty well defined. And then you get into really large private equity. I mean, you can see, they're looking for revenues 25 to 200 million, EBITDA 5 to 20 million. This is a big fund. So
Yeah.
that, go ahead. So that sort of covered different succession options. And any questions on any of that?
Well, the thing to know, making the decision to sell is the hardest part. And if you decide you're going to do it, because unless you're committed to this whole journey, it's not going to work for anybody. I mean, you're just wasting your time and efforts because it does take some work. And so you have to, take the time beforehand to learn everything you possibly can. Learn about ESOPs, learn about stuff. This is working on your business, not in your business.
Yeah.
And I would say that almost all of us are just working in our businesses. To work on it it's a different mindset, that's all.
Yeah, if you decide to sell your business, it's like a full-time job. You know, you really have to go through a lot of stuff to get to this point. And again, if you want to learn, if you want to dig deeper into this, go to our website. We have a deck on there. We go through and discuss this with Carl and Bill, what they went through in going through this process. And I think it's pretty eye-opening. Okay, I want to spend a little bit of time on the company uniques. You know, people say, oh, you know, what's the business worth? You know, 5 times, 7 times. Well, you know, those are general indicators. But really, when you get into the due diligence process, let's say you go through and someone gives you execute a letter of intent for them to come in. This is what we evaluate, and this is what others will evaluate. And you look at this continuum, we call it company uniques, but valuation is impact, and you could put risk here, and it's the inverse. So as risk, if you went this way, risk is increasing, which is decreasing the valuation. If you go this way, risk is decreasing, which is increasing the valuation. But, you know, we talk about the market served, you know, is it a dying industry versus one that's got a lot of growth? If you talk about customers, you know, do you have a high concentration of sales? We have one customer. You know, there's a lot of risk there. If you lose a customer, the business is gone. Or you may have few customers, but there's a real high cost of entry. You know, you've got some kind of competitive thing. You may have your own IP, you know, that only you have and it's patented and it's really, really valuable, so it's okay. So, you know, you have to evaluate the customer and the business itself. You know, the products that are manufactured. You know, what's the margin profile look like for those products? Are you a commodity, or are you something that the customer really values? And this gets into you know, what kind of margins does your business really drive?
When we look at a company, we're looking for secret sauce. That's our first thing. What makes you more valuable, or what makes you something that we can use? What makes you unique? And I know you can't see this stuff now, so look at it later. But it is. These are what we use as part of our evaluation.
Right. I think this is, you know, build a company with Termax. You know, they doubled down and did a very good job. They had their own IP. Very good processes, so that company, that business was very successul. You know, in a difficult market, you know, automotive's not so easy, right? I mean, it's a tough industry. The suppliers, you know, a lot of people they discount the supplier. Well, look what's happened with the supply chain. You know, and how disruptive that's been to a business. So, you know, looking at a business, you have to really understand the supply chain and the risks that are associated there. Again, we're looking at smaller companies. A lot of small companies, they have a CPA that's almost always just generally tax driven. How do I lower our tax liability for the year? They're cash basis taxpayers.
But that's very short-sighted. I mean,
yeah. So they don't run their business to improve the business. They run the business to try to defer taxes.
Or avoid them.
Yeah, and which is not necessarily the right thing for the business. So that's important to us. And then again, the management team, you know, that you have, and the human resources and the employee engagement that you have. You know, if you're wanting to continue that business, do you have capable people there that can take that business and continue to run it? So once we evaluate all those company factors, we've got what we call a valuation ladder. And, you know, this is sort of the way we look at businesses. If they're defined like this, what kind of multiple that you would apply based on the company uniques evaluation they have. And they don't always fit into a neat bucket. You know, they could be sort of all over the board, so it could be a blended rate. But, you know, our point would be you would go back and try to look at your company as an outsider, how an outsider would look at your company, and do an evaluation of your company to see its company uniques and how it really stacks up to how the marketplace will look at it.
Right.
So, do you want?
So, well, just very quickly, so the key is, I mean, for the company itself to make it, you're not all going to meet all those things, but to improve its value is to go ahead and have many of those items, or as many of those as you can. You know, it's paying down the debt. It might be. It might be just having an accounting system that's more.
You could rely on the numbers.
Right.
Yeah.
So there's just, it's really important to get an outside, not us, we don't do this stuff, but an outside consultant that can help you with those things. And it's, like I said, it's not necessarily a tax accountant. They've got a different approach.
So, you know, strategy and tactics to assess and create value. This first point says determine the best combination of valuation and succession for you and your business and your employees. So if I was a business owner and I wanted to succeed it to my kids or management, I would put a lot of emphasis on my banking relationship. You know, we're dealing with a very small bank in Minnesota right now, and it's very different than dealing with, say, Wells Fargo, who's the evil empire of all banking. Hopefully there's no Wells Fargo people here. So, but, you know, I would be wanting to understand from the bank, what does my balance sheet need to look like? What does my company need to look like where I can transfer this business without it dragging me with it as a seller finance? Tell me what that looks like so I can start to do that, try to position my business that way for that succession. Because that's very different than somebody says, I just want to get the most money for my business. I want to grow it as fast as I can. I'll take on debt. I'll do whatever I can to drive that growth, profitability, whatever, because I'm going to sell it. And so it could be a very different strategy then on how you position the business, you know, going forward. So once you make that determination, plan, invest, and execute in those areas, you know, and especially if you identified company unique, so yeah, I need to put in a MRP, ERP system so I can better manage my business. We can't overstate this point. You want to take that one?
I've said it twice already.
Yeah.
I apologize, but you know, you need help. I mean, and you know, you guys are good at running your business. All of you, there's guys that this is what they do for a living. Pay them their juice. It's so worth it. You're going to make up so much more money that way.
You need to get people that are experienced in doing deals, not just your local tax CPA or your attorney. And then get your people involved. Whatever you want to do, we try to get your people involved. Let them share with what's your exit strategy and get the right people to help you deliver that strategy.
Right. There's a level of trust with employees that I know my dad's generation didn't believe in. You don't tell them anything. And mine, we would talk up to gross profit. And I just made it a point that our people knew where we were up to that gross profit level. It's important that people have a chance to share in this stuff. So I just know that our guys were so more committed if they knew why they were doing something and if it was building something that's great. So we talked too long, sorry. But
Couple thoughts. You had a 5x multiple in EBITDA. I think it's more like 6 to 8. And I'm going to tell you right now, I think that because of our balance sheets, we're sub-S corporation. And the only smart banker I ever knew came through our plant just a year ago, and he looked out our window and he said, I like your balance sheet because it doesn't tell you how depreciated those assets really are. So when you have a huge barrier to entry like we all do, old
equipment
that is fully depreciated, your balance sheet tells you a big story. And I'll tell you, at my age, I don't want to sell my business because I want it to perpetuate, because you don't have capital gains on this thing either.
Right.
So the tax thing is a great point you're making here. I think the multiple's going to go up. I think in this industry, you can see an EBITDA go 7, 8 to 10, depending on your opportunity. So I want to pump a little bit more air back into the room here, because it's not like you got to run and sell.
Yeah.
These
Yeah.
are smart guys that work in their business, and I think they probably, when they understand what they've really got, it's a huge, huge opportunity going forward, given manufacturing in America. So,
I think you're right at some level there. But you also have to manage expectations.
Absolutely.
And I know that we did get an economist came and valued us, or did a valuation. And then we updated it 3 different times. That was valuable for us.
Mm-hmm.
And now we ended up selling it for more than his valuation was, double. So I thought to myself, well, I mean, I'm talking out of school, but we did well on that. It worked out better than I could have hoped for. But you just got to know what happens.
Not one-time revenue.
That's right. Well,
Well, thank you so much for listening. We appreciate it. Thank you.
thanks so much.